If you had invested just 1 lakh rupees in gold or real estate or stocks 20 years ago, how much would it be worth today? Well, the answer may surprise you. The key to success is structuring your own financial portfolio the smart way. Let's dive in. Hello everyone, I'm Satish. Welcome back to my channel. In today's video, we're talking about how to build a balanced financial portfolio using real-world examples, trusted data, and a simple rule of thumb that you can apply immediately. This video is for anyone who wants to grow their money smartly, whether you are 25 or 55. Let's start with the basics. There are three main asset classes that you should know. Number one, debt. Debt assets are examples of debt assets are fixed deposits, government bonds, anything that gives a fixed return. Usually you get around anywhere from 6 to 8%, no matter how the financial market performs. The second asset class is equity. Equity includes mutual funds, stocks, ETFs, all of these that have a market dependency. You can make more here, but the risk also is high here. The number three is other asset classes. Gold, real estate, cryptos, even art, right? I mean, we're not going to talk about art today, but all of these play a significant role and there is significant risk in all of this. Why does it even matter? It's simple, risk. When you're in 20s, if let's say you invested in a stock and it tanks, you have time to recover because the window is long. But imagine if you're 60, a wrong investment could cost your entire retirement money. That's why financial experts use a simple rule of thumb. It is nothing but 100 minus your age. That's how much you should put into equity. Let me break it down. Let's say you're a 40-year-old guy, then 100 minus 40 would be 60. So it means that 60% of your money should be in equity. And the remaining 40% should go into debt or other stable assets. So this way your portfolio is actually balanced and can grow safely based on your age. Okay, now let's back this up with some real world data, right? According to a research study done by Financial Express in India, if you were to invest 1 lakh rupees in 2004, by 2024 in 20 years, right? In gold, it would have grown to about 12.5 lakhs. That is about 13.5 CAGR. In real estate, depending on the location, results varied anywhere from 8 to 14% returns. For example, in cities like Mumbai, in Powai, or parts of Bangalore, returns were very high and better. But not all cities performed equally. In equity, specifically the BSE Sensex, your 1 lakh would now be worth 14.4 lakhs with a 14% CAGR. And for debt instruments, they gave a modest return around 6 to 8%. So the question is, why not just put everything in gold or in real estate? So here is the catch. Gold performed well in the last 20 years, but not always. If you check gold prices at goldprice.org, you will see that between 1980 and 2005, gold was mostly flat. That's literally 25 years of barely beating inflation. So banking everything on gold is risky. Same is with real estate. You can't put everything in one asset class. Sure, some plots might have given you 10x returns, but depends on where you invested, the government policy, infrastructure, the type of the paper, all of these, right? And all of these play significant role. And let's not forget, real estate is not liquid. You can't just sell like this, right? You need to really wait for finding the right deal. You can't sell it quickly. So also there are taxes, repairs, legal hassles, all of these things that you have to deal with. In fact, a property that I own near Bangalore is worth more today, but the rental yield that we put on it is around anywhere from 3 to 5%. It's barely after maintenance cost. That's what it's come to, barely beating inflation. So what's the ideal balance? Here is a sample structure for a 40-year-old. You put in 60% in equity. You could invest via SIPs basically, in index funds or mutual funds, and remaining 25 to 30% in debt related instruments like fixed deposits or bonds or PPF, all these kind of things, right? And remaining 10 to 15% you can invest in gold or real estate. But if you're already heavy in the real estate or all of these other asset classes, don't worry, you can start your future savings into the equity and debt so that it can balance out over a period of time. In fact, that's exactly what I'm doing with my portfolio. Investing more in equity so that I could balance out that. So to wrap it up, understand your asset classes, use the 100 minus your age rule, rely on actual data, do not make any assumptions, and most important, diversify your investments and avoid locking up everything in non-liquid assets like real estate so that you can't really get them when you need them. Again, it's all about building a portfolio that's balanced, resilient, and aligned with your goals. If you think this video has helped you think differently about your finances, give it a thumbs up, share it with someone you care about, and hit that subscribe button so that you can get more of these type of content. And if you got a topic in mind, drop it in the comments, and I'm listening, right? We'll create that videos on that. Thanks for watching, and again, I'll see you in the next one.